Welcome to Dr. David Eifrig's Health and Wealth Bulletin, a publication of Stansberry Research. This is Weekly Update. Today, I want to feature part of an issue from one of Doc's newsletters. It's called Income Intelligence, and that's exactly what it is. It's a monthly issue packed with the best intel on the markets, our economy, interest rates, and recommendations for income investors. If you want to invest in a solid portfolio of income-generating stocks, this is the only newsletter you need. The following comes from our May issue. It focuses on the dangers of recklessly chasing yield. And it starts with, don't ever buy 100-year bonds. Despite the incredibly risky nature of Argentine debt, last year the nation issued bonds with a 100-year term. And because of the chase for yield, investors bought them. Argentina has spent more than 75 years in default. More recently, as we mentioned, the country defaulted in 2001, then made it to 2014 before defaulting again. And yet it was able to issue bonds with a promise to pay back investors in 2117. These bonds made no sense. The long duration meant the price of the bonds would fluctuate drastically with interest rates. And the likelihood that these bonds will pay off in full in 100 years was close to zero. For all that risk, investors would earn a yield of around 8%. Still, the country offered $2.75 billion of debt and attracted $9.75 billion in orders. Shockingly, investors couldn't get enough. Now, Argentina offered this bond last year. Since then, they've dropped to a price of 83 cents on the dollar, with much of that drop coming in the past month. Collecting a 7% or 8% annual yield doesn't do much for you when the bonds drop 14% in a year. The fall comes because Argentina had $30 billion in local debt due the week of May 17th, and it looked like it may not come up with the money. Right now, Argentina is seeking an emergency loan from the International Monetary Fund to keep it solvent, and it just raised its benchmark interest rate to 40%. This trouble with local debt has driven the Argentine peso down around 33% against the dollar, making it even harder for the country to pay off its dollar-based debts. So after issuing a 100-year bond, Argentina is at risk of defaulting within 1 year. So today we show you how our income-focused model portfolio has been outperforming despite the yield-starved market. When investors only claim an 8% yield on dead credit from a serial defaulter with a 100-year term, how can you expect to earn a fair yield in a reasonable, safe investment? We've done it, though it hasn't been easy. Right now, our income portfolio boasts an average yield of 5.6%, and our yield on cost, the current dividend divided by the price we paid, is 7.6%. We've also invested intelligently in equity with upside potential. While a stock with a 3% or 4% yield may not appear to be a juicy income investment, when shares rise 50% or 125%, like they have with VF Corporation and CME Group, they reward better than any dividend yield. Right now, our average gain in the income portfolio is 33%. And if we include our world-dominating dividend grower positions, our average gain is 77%. Of course, we remain focused on income, and with benchmark interest rates sending the yield on 10-year Treasury bonds to 3% or so, you'd think we could find better yields in more places. In fact, it's the opposite. While the baseline yield is up, spreads have tightened. And in a sense, spreads matter more than rates. Here's the spread on high-yield debt as measured by the Bank of America Merrill Lynch U.S. High Yield Master 2 Option-Adjusted Spread. Despite the mouthful of an index name, the concept is simple. It shows how many more percentage points of yield you'd earn on a high-risk junk bond than you would on a super-safe Treasury bond. Back in 2016, you'd get nearly 8% more in yield, or more accurately, 800 basis points, for taking on the credit risk of junk bonds. Today, you earn just 3.4%, or 340 basis points more, flirting with the lowest levels of the past 2 decades. Now, if you could be certain those junk bonds wouldn't go bankrupt, maybe that's enough. But these low yields come right at a time when credit quality looks worse than ever. In the next 5 years, $2 trillion in U.S. corporate debt comes due, and more than $1 trillion of that rates as junk. Second, corporate profit margins have danced around levels that simply don't fit history. Yes, when profits are high, debt is safe. But looking at this chart tells us that corporate profit margins are more likely to decline than increase. Profit margins are a mean reverting measure. Remember, trees can't grow to the sky. You could make the case that highly profitable information businesses may have pushed the average higher than it was decades ago, but profits are more likely to fall from here than they are to rise much further. Finally, today's junk debt doesn't have the same guarantees it once did. In the old days, bond offerings included covenants, agreements from the borrower that it would stick to a certain debt level, like loan-to-value and leverage ratios. These agreements made the bonds safer and helped attract investors. But as investors clamored for yield, borrowers realized they didn't have to include these costly guarantees. Bonds without such safety mechanisms, called cov-lite, started flowing through the financial system. Covenant quality on bonds has declined, but the real trouble can be seen in the leveraged loan market. The amount of cov-lite loans issued rose from virtually none in 2010 to at least $571 billion in 2017. Today, about 77% of new loans issued are cov-lite. Now, before the 2007 financial crisis, they accounted for 20% of the loans. That means today's low spreads earn you less money for holding worse bonds. The oddness extends past the fixed income market. For decades, investors could work on a frothy market playbook. When stocks got too high, you could retreat to sectors like consumer staples to collect dividends and protect your capital. But that's not so easy these days. Since 2010, consumer staples have sported higher valuations than the market as a whole. These are boring companies like Walmart, Campbell Soup, and Clorox. They should be priced cheap and have sturdy share prices. Instead, they were priced at a premium. And in the last year, consumer staples have underperformed the broader market, as you can see in this chart. So much for safety. In other words, the traditional safe havens for income investors have either been bid up to levels where they deliver little yield, or they've been failing. That's why we've worked so hard in our portfolio to deliver better investments. It's why we ventured so far as to recommend Russian telecom stocks, emerging markets, preferred shares, and carefully timed entries into master limited partnerships and exits out of municipal bonds. Still, as the markets trend higher and both the bull market and the economic expansion runs longer, we need to get more cautious and more creative to keep income checks flowing without risking our capital. Now, this right here is the heart of income intelligence. Keep the income checks coming without risking capital. Keep in mind, all of this was from our May issue. We have plenty of new, up-to-date research ready for our subscribers as well. If you want to find the best income-producing investments, you need to read Income Intelligence. And if you aren't a subscriber, we have a special offer for you. It's one of the best deals we've ever offered on this publication, and it comes with a 30-day window to see if it's right for you. We're also including a special report called How to Triple Our Money and Collect a 6% Dividend on the Index Effect. It includes specific, easy-to-follow instructions so you don't miss out on a chance to triple your money on a world dominator and collect a 6% plus annual dividend while you wait. But don't miss your opportunity. This offer ends tomorrow, July 14th. So check out the link in the description below and get started on the path to securing your retirement income today. That's it for now. Thank you so much for watching. Don't forget to like, share, and subscribe, and we'll see you next week.